What on earth is going on? If you've been investing in the stock market over the last week, then you know it kind of felt something like this. Yeah, you know what I'm talking about. Look at me. I'm a mess. Alright, I'm back. I've composed myself. Alright, so we're going to talk about what's going on here. And then I'm going to share with you my portfolio. Yes, there are losses. But we'll look at it together so we can commiserate with one another and share in the pain. And then I'm going to show you something that will really freak you out. You see, a lot of people think, well, if the market drops 5%, it just has to go back up 5% and we'll be even. Well, I'm going to show you why it doesn't work that way. So stick around if you want to be depressed, discouraged, and freaked out. That's really not a very good hook, is it? I gotta work on that. I really do. Anyway, all of that happens right now. Hey everyone, Jay here. Hope you're doing well. Welcome to Jim.
Subscribe.
You know, since March, the stock market has been having an incredible run-up. Tech stocks specifically have been going up like crazy, especially in the last few weeks. It was a run-up that clearly wasn't sustainable, and a lot of people suspected that the party would soon come to an end. Well, last week that's exactly what happened, and the stock market just handed everybody losses. It almost didn't matter what you were invested in last week, you were down, especially if you were invested in IT. We're not going to go into this a bunch, but it's widely suspected that SoftBank was a stock market whale in this case. And if you don't know what a stock market whale is, it's basically someone that comes into the market with so much money that they can actually skew the prices of the stocks they're bidding on. And then they can sell all of it and leave all you suckers holding the bag. Ha ha ha! Just take a look at this chart. You can see over the last few weeks, the single stock calls are far outpacing anything else in the market. This increases the volatility of the whole market to a great deal, and last week we saw the results of what could happen, as the market cleared away some froth right off the top. So what does this mean? Should we all panic sell right away? After all, I thought they told us stocks only go up. And before you panic sell, you should know that this is completely normal. In fact, it's not uncommon at all after a massive run-up for a market to have a correction of 10 to 20%. Of the 23 corrections we've had since World War II, the average correction was a decline of about 14%. So if you're truly an investor and you're in this for the long haul, then if anything, you should consider this an opportunity. Things are going on sale. Now to be fair, we haven't quite entered correction territory just yet. For that, it would require a decline of at least 10% off the peak. And at the end of last week, we were only down about 7.45% off the peak. And who knows what will happen in the coming week. Maybe by the time you're watching this, the market is already going back up. Or maybe we will end up in correction territory. And I know it's hard to put money into the stock market when you put it in and poof, burns up. It's like throwing your money right into an oven. Because really nobody knows where the bottom is. But you shouldn't bother yourself trying to time the market right at the bottom, because odds are you probably won't be able to time it correctly. It's far better just to dollar cost average into the market. If it goes down more, put a little more in. Keep buying diversified ETFs or blue chip companies that you really believe in, and in the long run, you're most likely gonna be fine. So let's take a minute to look at my portfolio and see my losses. Almost sounds like I'm excited about losses. We don't have time to cover everything, and this isn't meant to be a full portfolio analysis, but I just want you to see that there's definitely some significant losses in my portfolio. Everyone has red days, it's normal. So I'm gonna show you some of these losses that are going on here. So maybe if you have some losses too, you won't feel like, oh man, I'm the only one. You can see versus my last video, I have been putting some money into the market, but we're working on it, trying to build this portfolio up here. But look over the last week, you can see the highest value I would have had is about 91,000. If you look at the month, here's this peak right here. I guess that's what, 95,000? But as it stands right now, we're in the red down to 88,931. And there could be more losses to come, let's be real. This might not be over yet. Anyway, some of my biggest positions are down the most. You look here at Microsoft, it's down to 203. And you can see my cost basis is 209, which is a little rich for Microsoft, but I think Microsoft is a great company and it's gonna be all right in the long run. All right, same thing with Apple. 50 shares of Apple. My cost basis is still all right. Apple's down to 112 though. It's getting a little close. I know everybody likes to see Tesla, so we'll take a look at Tesla. They're back in the green. You know, I'm hanging out with my 5 shares with a cost basis of 279. I've got some room to jump in if I want to get a little more aggressive with Tesla, but I just don't feel like that kind of a roller coaster is what I want to get involved with right now. I do believe in Tesla long term as a company, But things are just all over the place here. I know some of you love this kind of action, but you know, I'm not a big risk taker. I'm all about consistent, strategic, long-term profits. I do like dividend stocks. Here's a pretty good play I have. 100 shares of AT&T. That's a fun one. I also like SPHD, which does seem to be a little green. SPHD pays such a good dividend, and they pay once a month. You gotta love that. All right, so there you see it. I've definitely taken a beating over the last week. My strategy is one where I don't want to gamble. I'm in it for the long term. I know that in the long run, the market does tend to go up. So I like to invest in ETFs and really solid blue chip companies. And so that's what I'm doing. You get a lot of these channels that are talking about, yeah, buy options, calls, puts. Those involve leverage and those amplify your risk. I really think that most people should stay away from sophisticated stock market investing tools that amplify your risk. The best strategy is to invest consistently into a good, diversified, low-cost index fund over the course of 15 to 20 years. And in the long run, you should do just fine. A couple of ETFs that I really like are VTI and VOO for growth, and VYM if you're interested in dividends. This is not financial advice, and you should never listen to some random guy on YouTube. And don't get freaked out when the market goes down. It's totally normal. The market goes up, the market goes down. That's just how it works, as long as the long-term trend is upward. Speaking of which, in the beginning of this video, I talked about people who say, well, if the market goes down 5%, it just needs to go back up 5% and we'll break even. I'm gonna show you why that doesn't work. All right, guys, so created this little experiment over here. You guys are gonna love this. What we're gonna do is look at how the value of an investment might change day to day with a certain percentage drop and a certain percentage rise every other day. We're gonna start out with $100,000. And then we're gonna say, what happens if one day it drops 5% and then the next day it goes up 3%? We're gonna alternate it in that way. Right away, I think a lot of people would say, well, obviously, if every other day it's going down more than it's going up, you're gonna end up losing money. That's pretty obvious. We're gonna see how this ends up over 2 months. So we scroll down and we lose 5% on day 2 and we're down to $95,000. Then we go up 3% and we're back up to $97,850. And this goes on and on and on. I'm not gonna go over every single number, but you get the idea. Let's cut to the chase. And we get down here to day 60 and we've got $50,000. Half our money is gone in 2 months. If that were the trend in the market, down 5, up 3, down 5, up 3, we'd have half our money gone. But what if we were down 5 and then up 5? I think a lot of people would assume, well, then we're gonna break even because we're down 5 and then we're back up 5 and then we're down 5 and then we're back up 5%. Well, check this out. Down 5 to 95, but then up 5% because we're only up 5% on that amount. And then this keeps going and going, and look, we're losing money. Well, let's check out where we end up after 2 months, all right? $88,000. That's just wild, right? So if the market's going up and down in what seemed like a linear fashion, we could actually end up losing money in the long run. Now here's what's crazy. What if we work with smaller numbers? Let's assume that there's an upward trend. Let's say we're only down 0.5%, and let's assume that we're up 1%. This is where the true power of the market comes in, because in the day-to-day fluctuation of things, this doesn't seem like a lot going on. It seems like a relatively flat market. And the market closes down 0.5%, but then the next day we're up 1%. These aren't really big moves, but check out what happens in 2 months. We just made almost $15,000 with these little tiny market moves. And that's the power of the market compounding on itself. And it could work both ways. But the good news for us is that in the long run, the market does tend to have more green days than red days. And this is what makes stock market investing a good move in the long run. And this is why I don't think we should get too hung up on what's been going on over the last week, especially when we just had 10 green days in a row. All right, just a little experiment. Hopefully you guys found that interesting and helpful. All right, that's all we got for now. If this added any value at all to your life, please hit the like button. Also, please subscribe. And until next time, you guys are awesome.